Welcome to the Active Allocator Insight Series. We hope that educational presentations such as this one will further your understanding of asset allocation and portfolio construction. In this video, we illustrate how Active Allocator can be a great way to help you build alternative investment programs for your affluent clients. So let's get started. Alternative investments at just 4% of typical retail portfolios remain grossly underallocated. This is, in part, because many financial advisors lack sound means to quantify and demonstrate their accretive portfolio benefits. We are not speaking about generic benefits here, but specific benefits within the context of your particular clients to allocate appropriately, as well as to access portfolio exposure by investing with the right set of fund managers. Given mind-boggling heterogeneity across subtypes within real estate, private equity, hedge funds, liquid alternatives, managed futures, oil and gas, credit structures, and fixed income substitutes, this is easier said than done. Over 150,000 advisors affiliated with independent broker-dealers, over 30,000 registered investment advisors, and hundreds of family offices need a simple way to understand and to explain alternative investments benefits. We have created Active Allocator to do precisely this. Our portal allows you to create more thoughtful portfolios. It lets you easily model over 50 asset subclasses. It lets you evaluate investment opportunities from traditional asset managers and hedge funds, from alternative mutual funds to managed futures, as well as from illiquid investments in structured credit, private equity, and real estate. In minutes, you would be able to quickly arrive at long-term strategic allocations, make changes to portfolios, assess risk, and simulate likely outcomes. You would raise the quality of discourse you have with your clients. Our portal lets you utilize the right set of actively managed investment funds to construct better portfolios. It brings together asset allocation to alternative investments with portfolio construction and manager selection. Asset allocation. Our asset allocation module in seconds analyzes the statistical properties of your client's existing portfolio. It then recommends the best combinations of asset subtypes that improve the portfolio on a variety of chosen metrics, going far beyond conventional risk and return trade-offs, while personalizing for unique preferences. We bring together liquid and illiquid investment analysis in a seamlessly integrated framework and generate a client proposal for you. This will help you quantify the benefits of adding to or removing from some asset classes as you discuss long-term allocations with your clients. Portfolio construction. Our portfolio construction module overcomes challenges that you face when allocating to active managers. It helps you in comparing fund managers, accounting for their limited performance histories, and separating true skills from dumb luck. It lets you sift through opacity in a fund manager's returns generation process. Unlike traditional approaches that are nearly always historical looking, we proactively forecast the degree of uncertainty in return, volatility, and correlations of your fund managers. You will have the ability to include soft qualitative views from due diligence functions and incorporate a degree of confidence within a quantitative manager allocation framework. You will instantly know how much to allocate to expensive skilled managers versus accessing an inexpensive passive benchmark. You will be able to show your clients appropriate relative allocations across skilled fund managers. Imagine how interesting it would be if you could calculate the impact of adding or removing a fund manager from a portfolio, or to contain a manager's strategy and style drift over long periods of time in illiquid investing. Of course, there is a lot more to portfolio construction than meets the eye. We let you generate a bunch of metrics so that if you want to delve deeper, you can do so at the click of a mouse button. We let you separate beta that you can get cheaply from alpha, expensive skills-based returns for which you pay high fees. We let you create the right mix of passive and active investments if you want to. We help you quantitatively demonstrate to your clients the accretive aspects of illiquid investments and actively managed funds. We generate a ton of metrics on risks. Not all of them might be relevant for you, but they are there just in case you need them. We help you dissect your investments and funds by separating the value that comes from security selection, market timing skills, and just plain passive exposure where a rising tide lifts all ships. If you are worried about embedded leverage in your total portfolio or within a particular fund, we help you quickly isolate it. You can then take a decision on whether a fund is too risky for your client. Nobody can predict the future. However, our algorithms are based on various scenarios of the future unraveling. We don't make point estimates, but base our algorithms on probabilistic assumptions. This, of course, raises the complexity in our back-end algorithms, but it insulates you from false precision. We help you decide how much illiquidity is good for your client after you have expressed a general preference or aversion. We help you calculate the cost and benefits of illiquidity and whether you are being adequately compensated for taking on illiquidity risk. In the real world, historical returns are not, especially in alternative investments, as they say in the jargon, normally distributed. They do not follow the 80-20 rule. Our algorithms take into account higher moments of negative skewness and kurtosis too. This creates more robust optimizations. It helps you create more resilient portfolios for your client. Returns, of course, come from multiple sources. An efficient market, such as the S&P 500, has its returns in basic market beta, while an illiquid private equity investment may draw its returns from skills and illiquidity premium too. Our algorithms break up returns into their various components for you. Allocating to multiple sources of return helps you create more robust portfolios for your clients. There are statistics and there are statistics. We have identified the most useful ones that might be helpful for you when you make investment decisions or when you discuss them with your clients. This brings in a fact-based approach to your decision making. You can use our portal to generate lots and lots of scenarios on the fly. Such analytics help support your own mental models and shields you from bias. To conclude, we believe that using our framework will help you attract and retain new assets. By blending human and digital, we help you strengthen your relationship with your client. We foster collaborative advice. You can rely on cutting-edge finance theory expressed through our state-of-the-art algorithms to build alternative asset class exposures for your client. We encourage you to take a test drive, build a few model portfolios, and see how Active Allocator might be useful for your clients. Thank you for listening in.